tell that you are present in here because you would be definitely rewarded for your patience for having come in here, because you'll be the very first to hear some unique ideas that were not previously discussed, that were mentioned but never brought to public. But before you hear the details, could you please tell me who of you supports Basel III standards implementation? Could you please raise your hands? None. One. Or is anyone for Basel IV regulation? You know this review of trading book, the new capital charge for credit cost protection and all that sort. Does anyone support it? The same result. And I'll give one explanation in the very end of the presentation why it happens. But first I would like to start from the motivation why I decided to speak to you about this pan-CIS regulator creation. Why might it come into being? First, last year in autumn we received a request from the Bank of Russia that stated that it wants to harmonize regulation by January 1st, 2020. And it is actually the reason that we might assume that the trend, like with the European Banking Authority created as a pan-European regulator, that will have the one on the CIS area. But what should we consider if a sort of regulator is to appear? First, let's just make a small snapshot of the current regulation, quite clearly for you to understand the gaps. Another will trace some of Basel III consequences. You remember Yelena was speaking about too systemically important to fail. I would actually be interested in focusing on the impact of particularly this sort of regulation. And also I would like to discuss some other issues that are of strategic importance or of strategic consideration for you just to bear in mind. And maybe when taking the managerial decisions or just talking to your regulator or some other regulator to understand what are some pros and cons that actually is related to this question with Basel IV regulation. So what's the snapshot? Of course, Yelena has much deeper knowledge about the comparison of 4 selected countries, Russia, Kazakhstan, Ukraine, and Belarus, that we've chosen, actually the countries where our banks or our subsidiaries do operate. And just to bring you some ideas that, though comparable in sort of banking system penetration, the number of banking assets to GDP, we're quite different in terms of understanding, in terms of Basel I risk weights, how to estimate the same risks. Because I would just explain, the request that we received from the Bank of Russia asked, could you imagine if your Russian subsidiary operated at Ukraine, what capital adequacy would have it received? Otherwise, your Ukrainian bank, if it operated in Kazakhstan or Russia, what capital adequacy would it have? And that's why we've tried to benchmark the current regulation. And to be honest, it was quite difficult, though there are similarities, but those presented on the slide, let's say mortgage is the example, they are showing that though all the regulators in all 4 countries departed from the same Basel Committee standards, somehow they came to quite different understanding and interpretations. Just to say about the minimum capital adequacy threshold that is in place for all of these countries. So what we do see, though banking systems generally might be said to be somewhat comparable, not as developed in the US or UK, but still quite different in terms of the regulations. And now, we can easily harmonize what's about Basel II to issue a sort of a guidebook, like we've done in Russia that Ferdinand just shown. But what will be with Basel III regulation? I'd like to draw your attention to the figure. I'll explain what it has. We've done research and tried to model what might be the impact of systemically important banks regulation, assuming that real banks, they are searching for their optimal strategy for a sequence of periods. So, and why we've done this? We've done this because, you know, the history of systemically important banks regulation is quite short. We've been announced with the 2 lists of global systemically important banks published in November 2011-2012 by FSB. But still, we do not trace the impact, whether it's positive or not. So what we've done, we've tried to benchmark and model the behavior of the banks, and in order that they do compete in terms of loan amounts. It means that actually, as you know, the systemically important banks regulation, in general, the larger is the bank, the more systemically important it's considered, and the larger capital charge or capital buffer add-on he is to receive. So what we've got on this figure, the green line is the assumed cycle of the interest rate. Yes, it's like just a cycle, the ordinary one, but it is needed to trace what would be the impact for the capital of the banking system and of the total loans offered by banks. What you can see, the green line, the blue line is the amount of loans offered given no systemically important banks regulation. And the red line is the one with the sci-fi systemically important banks regulation. The key things for you to take out of this graph is that, you see, they do depart from the same point, but that's actually the decrease in the peak, and the bottom point is not that low. That's exactly the objective of the policy, what was introduced. So regulators wanted to decrease the volatility of lending. So the peaks are not that high, the bottom is not that low. That's exactly about financial stability as they propose. The problem is that, you see, you cannot recover as fast in the downturn period. That's the drawback when you introduce it in the times like we are living with you now. Another issue, if you take the general trend, the general long-term economic growth path, it's lower. And that's another drawback that this regulation has that comes to mind. But there is another problem. Do you remember this difference in the capital adequacy that we've got country-wise? For example, in Russia, the 10% minimum is justified by the Basel ratio of 8, adjusted for another 25%. Assume that this capital buffer add-on that currently is assigned as 2.5% being able to be raised to 3.5 for currently empty group. What might happen if we try to calibrate this capital add-on? What happens with the capital of the banking system? Towards some extent, the capital of the banking system would grow. The capital of the banking system would grow because of this extra buffer that would be imposed for the systemically important banks. But if the appetite of the regulator would increase, and it would, by any arguments, adjust the coefficient by 25%, by any other, and use, let's say, not 2.5, but 3.5, 4, let's say, for local uncertainty and risks, it would get the sharp dip and decline in the amount of banking system capital because of one reason. The optimal strategy when this capital add-on is high is to try and reduce the bank and the growth. And that's actually the unforeseen circumstance that is never told to be favored, to be followed, and honestly, it wasn't discussed. That's just one issue of the Basel III regulation. And now I want you to be quite careful with the next figure that is quite controversial, that is first to be presented, still that might provide you with some idea why there is Basel I, II, III, or like Thierry said, Basel VI. Why is it? It's because of the simple issue. What is in this graph? The blue line is just the S&P average index. S&P is, let's say, the world proxy for the global stock market index. The only issue is that that's not the very bottom point for 2007. It's the lead variable for the 2 years. Because you know that the S&P decline was in 2009. That's just for convenience. The graph is shifted 2 periods ahead. Why? Just for you to see the linkage with one simple variable. And this variable is depicted in red. And this variable presents the number of pages published by the Basel Committee per year. Starting in 1998. Starting 1998, after the crisis that can be judged whether it was more originated from the Thailand or from Russia, from that time when the banking regulation has shown to be inefficient, there was published 6,000 pages. Most of them are still actual. They were not reviewed. So assume just the ordinary banker is somehow supposed to live in the UK precedent law system that he should have known all these 6,000 pages manuals. But what's more crucial? You see, it's strange, but the dynamics of the two-time series is strongly correlated. You might say, well, there is some sort of spurious regression, it's just the mathematical tricks. Unfortunately, it is not. Unfortunately, there is the logic and interpretation that corresponds to this alignment of the trajectories. And the key interpretation is that you as the bankers can really understand it. What does this lead of 2 years mean? The lead of 2 years mean that, just assume, the new regulation, the updated version of Basel II that came into being in 2006, the first was in 2004, it was to be understood by the bankers, adjusted. There was a discussion about the risk arbitrage and regulatory arbitrage. So it took 1 year for bankers to understand the rules, to implement the rules. And 2008, it was exactly the strategy that scored only 15% in Yelena's presentation for Russian bankers that was called RV optimization. That's exactly how these 2 years might be interpreted. And as you can see, 2010, considered to be the year of Basel III publication, that provided a lot of headache for the bankers to understand what is it all about. But to be honest, we might assume that it took 1 year to get more or less adequate understanding. And unfortunately, all the complexity of regulation is not adequate to capture these changes in behavior. And that's the forecast for the S&P index, though unfavorable, but that's what we can deduct from the mathematics. But still, the key reason and the key point to be taken from this dynamics of two-time series is that this our complexity, exaggerated complexity of the regulation is not the proper way to go. Of course, you can imagine 2013 has not yet ended. Basel Committee and all the rest can publish, they need to publish just 3 documents, 150 pages each, to stimulate bankers to be more stringent, more risk conservative, less dynamic. But you cannot go this way for a long period. Do you remember the history of the Basel banking regulation? The crisis of 1970s, where the insurance, the quasi-banks in the US that survived the 1970s, 1980s crisis had an average ratio of capital to assets of 8%. And it was supposed to be the second best optimal for the regulation. Yes, it was simple, but still it provided no sort of arbitrage. It was easy to implement and to monitor. Now, with all these 6,000 pages, or even more now, given FSA regulation, EBA regulation, etc., it's not adequate. It's not covering all that's needed. And what's actually needed? A more simplified regulation, but just like a common tax rate. That's what's needed. But how to find the one is for special discussion, both within CIS area and international. Just to summarize, so we've seen that there is a room for harmonization in between the CIS area. Still, we can easily adapt common standards for internal ratings of Basel II. But as for Basel III, we should be very careful. We shouldn't speed up. As Russia, it was the very first, mostly the very first to implement Basel III. The United States are still not to adopt them. CIS is not the one to be in between the very first, to my mind. Because you see, all these capital buffers, they might achieve the objective of the financial soundness, but it might have the other side of the coin, that the capital might decrease. That's what Elena was saying, that it's weighted about the capital adequacy for Russia and for the amount of capital that it might decrease. That might be the response for the so-called over-complexity. And if we speak about this Basel IV, about remuneration regulation, about trading book review, securitization, etc., it is really the complexity that is not weighted and not demanded and, to be honest, not needed for the efficiency. Because the organization, the sound organization, is not too conservative, but it is the one that is efficient. And if the institution, the entity cannot score the retained earnings, it won't survive. And that should be considered. So, thank you.